All right, everyone. Welcome to our last digital finance seminar series of the term. Today, it's my pleasure to introduce Lin William Cong, who is visiting us from Cornell, where he is the Rudd Family Professor of Management and Associate Professor of Finance at the S.C. Johnson Graduate School of Management. He is also the founding faculty director of the FinTech initiative there. He is a research associate in the NBER Asset Pricing Group. In addition to that, he's won a number of awards, including Kaufman Junior Faculty Fellow, Poets and Quants World's Best Business School Professor. Sounds pretty exciting. A number of other awards. He's a finance editor at Management Science, also an editor at a number of other journals. And today he's going to tell us about the dark side of crypto and the tokenomics of staking.
Thank you. Thank you, CMAC, for the introduction. It's a great pleasure to be here. Thank you for coming. What I'll do is maybe a little bit typical. I'm not going to focus on one paper. I'll still have one paper that I spend more time on. But I just want to go through a number of projects that somewhat highlight the dark side of crypto and Web3 or DeFi. And one question that I often get is, what is the bright side to start with? You're going to tell us the dark side. But with this audience, I hope that's not an issue. You've done a lot of work. And there is an emerging literature on blockchains and DeFi. So hopefully we don't need to worry too much about that. But there are some serious issues we have to resolve in order to move the field forward. So I'll start with market manipulation, which is not illegal yet, but it's a gray area, and gradually shifting into some issues that we observe in the system, such as concentration of market power through vertical integration, so on and so forth, and then whether the system is doing what it's supposed to do in terms of financial inclusion, financial democratization. And then we move onto something that's clearly illegal, crypto-enabled cyber crimes, just to present you some facts and patterns. And then I'll spend more time on the last part, which is to understand the staking, both in the base layer in terms of proof stake and also at higher layer programs, and how that affects token pricing. So very briefly, I'll start with one form of market manipulation. There are many different forms, pump and dump, spoofing, but Wall trading has been quite prominent over the past few years in the crypto space. And Wall trading is essentially you buy and sell the same assets, or very close assets, around the same time by yourself. And why would anyone do that? Well, it turns out that there are good reasons, at least for an exchange to do that, because you can fake transaction volume. And if you create the impression that you have a lot of liquidity, then others are going to come to trade on your exchange. You collect more fees, right? So at least centralized exchanges have that incentive. Decentralized exchanges, I think there are other studies exploring that more. So what we look at using data from back in 2019 involves 29 different crypto exchanges. They're all centralized exchanges. And in case you are looking for FTX, it wasn't there. It just started. It wasn't very prominent yet. Essentially, you see all these transaction data or trading information. And our time series is not very long. It's only a couple months. But we can already observe some patterns. So among the 29 regulated centralized crypto exchanges, 3 were regulated because they had a New York license. Others are not regulated. You can use different definition of regulation. You can take the British standard or Japanese standard. The results will be similar. But that's the standard we use. So to detect Wall trading, crypto Wall trading, we essentially exploit several statistical patterns. One of them is Banford's law, which is about the distribution of the first significant digit of a data set that's naturally generated. It could be the length of river, heights of mountains, sizes of firms, and in this particular case, the transaction amount, right? And that law holds in equity market, in some other asset market, Forex market as well. We just want to see if it holds on these exchanges. So the red dot is what is supposed to be for the distribution of the first significant digit. There's a theory behind why this is the case. In the interest of time, I'm not doing that. But if you look at the blue bar in the middle, that's a regulated exchange. Here we use R2. It's basically Coinbase. And for a regulated exchange, it seems to comply with the pattern. But if you look at the two bars on the two sides, one is, we call it Tier 1 unregulated, Tier 2 unregulated. Tier 1 is just more prominent, larger, higher in the third-party ranking system. Neither of them comply to Banford's law. So that's already a red flag. Because unless the traders or Wall traders knew ex ante that they are going to be examined or inspected with Banford's law, they wouldn't fake their orders in this particular manner.
So the Banford's law is like a power law?
It's not quite power law. It only concerns the first significant digit. You can look at first two or first three significant digits. There are corresponding distributions as well. And it has something to do with how the data generated in our world, right? If you think about investment return, it's a multiplicative process. If my return is either 2% up or 2% down, it's a multiplicative process. And once you go from there, you can derive the distribution. It doesn't have to be base 10. It could be other base as well.
Just a question.
Yes.
So the green and the red are both unregulated exchanges?
Both are
one is a large unregulated, one is a
Yeah,
small.
one is higher in the...
Which one is which?
The green one is the better ranked.
Like a larger exchange?
Yeah, larger. And it doesn't quite matter how we cut or do this categorization because all these are reported at exchange level. But we think the higher rank ones are, presumably they care about their reputation a bit more, so maybe they tone it down a bit. We don't see, there's a difference, but not enough to say that the higher tier 1 unregulated exchange are not WOS trading. They're still WOS trading in the setting. That's just one statistical regularity. Another behavioral regularity is when we submit orders, we tend to round up.
So what's the implication of your, because that's estimate?
The implication is for that particular exchange, maybe something odd is going on. It's a red flag. And this is not for quantifying the WOS trading yet. Because, the first significant digit doesn't quite tell you the whole distribution and all that. But it's raising a red flag. As one way of detecting. Of course, in the paper, we do this more carefully. You can calculate the deviation, the divergence from the Banford distribution, and so on and so forth. And do chi-square tests. But the second behavioral pattern that we use is just rounding. We tend to round things up to 500 shares, $5,000, rather than a long string of digits in our transaction. And if you look at, again, a regulated exchange, around the multiples of 5s and 10s, the frequency of that transaction order tend to spike up. Whereas on an unregulated exchange, you don't quite see that. And even the whole distribution look a bit odd. So this one is basically larger orders are less frequent-ish. There is some monotonicity here. Is not very authentic. And coming back to power law, the third way of detecting is actually using power law. I didn't include it in the slides. Basically, the tail of the transaction distribution should follow some sort of power law fitted to the coefficients. And we do find unregulated exchanges actually don't fit. Doesn't matter how you tune the parameter, whereas regulated exchanges do. So what all this tell us is there's something not so authentic, something anomalous about these exchanges. But how do we quantify the WOS trading, the amount of WOS trading? We can't use power law because that's just part of the distribution. First significant digit doesn't help too much either. But rounding and unrounding could be helpful. Basically, for authentically generated transactions on an exchange, there might be some base level ratio of rounded versus unrounded orders or transactions. And unrounded orders could happen, right? If you use an algorithm, sometimes it doesn't round up. But anything beyond that base level, we are going to take a stand. They are generated by some was trading created by bots that the was traders do. And if you take that stand, after controlling for even exchange characteristics, what you can show is, on average, unregulated exchanges was trade almost 70% of their volume. And this is going to be a few $1 trillion per quarter, which is bigger than overall transaction volume on equity exchanges, but smaller than Forex. And that's true to the kind of nature of cryptocurrencies. It's almost a hybrid asset, right? It has some currency features, but at the same time, it's also an investable asset. Could this have changed? Absolutely. After 2019, right? Exchanges take actions. Was traders, they might respond to potential detection and all that. So if you are doing a litigation case, want to catch some was traders, you probably have to update your detection tool as well. And there are studies, for example, by Evgeny Leander's, Daniel Rabiti, they introduced more statistical tools to do it. So just a quick illustration of manipulation issues and how we can potentially deal with it. Here's another motivation for was trading by individuals, not by exchanges. That is for tax loss harvesting. And here is the idea, right? This is the timeline of tax events in the US. In 2018, IRS issued a few letters to crypto traders. And the last one was specifically to Coinbase account holders, saying, we're watching you, so you better report your gains or losses. And given that you have to comply more anyway, because the risk of detection is pretty high for tax evasion, what you can do is, I may as well do some tax loss harvesting. And this is how it works, right? After a decline of, let's say, Bitcoin price, I have a losing position towards the end of the year, I can quickly sell the position and buy it back. This is also a form of was trading. And because the tax regulation on crypto is not clear yet, people are going to count this towards a accounting loss for their tax. And they can
30-day, and like in stocks, there's a 30-day.
Exactly. But there wasn't one for crypto.
Wasn't there? Isn't?
Is not.
Yeah, there isn't.
Still not.
There's discussion on that, but I don't think there's a very clear implementation.
The advice from all like the top tax firms and stuff is there isn't, so it's perfectly legal. It'll probably change at some point, and then the question would be whether the IRS potentially retroactively changes it. To say if you did it last year, sorry, it doesn't count.
Yeah. And essentially, people can use this to offset their tax gains, right, from investing in real estate or equity. And that turns out to be what we observe in the data. For example, was trading volume shoots up towards the end of the year after huge declines in the major cryptocurrencies, so on and so forth. And it's leaving a significant amount on the table for the IRS. Now, this is not a general equilibrium conclusion, right? Like, if they know this is the case and policy change, people's reaction will also be different. But just as a ballpark estimate, right? Like,
so the idea is that when you have a lot of loss in that year, you create a fake trading to...
No. So basically, suppose I have a large gain in real estate investment and have to pay tax on that. But then I can quickly sell my losing position in crypto. But without losing that position, I buy it back immediately. Strictly speaking, it's kind of kicking the tax payment down the road, but that's a form of tax loss harvesting. It's not allowed, at least doing was trading for tax loss harvesting is not allowed in equity or in other assets, but it wasn't explicitly banned in the crypto sector. So that's another reason why people can manipulate or do tax loss harvesting. So those are some manipulative behaviors. What about other downsides of the rise of cryptocurrency or rise of mining activities, right? Mining activities are just competitions for the rights to provide services. And what services are we talking about? The service of recording the transactions, recording the states of the network. So what I'm showing you here is based on Bitcoin data. And there was a couple years ago, there was the concern of concentration of mining activities because of mining pools. Mining pools are just portals where we can all contribute our computation power and we share the rewards. It's essentially a risk-sharing contract. And Agostino has done work on that as well. What we showed earlier in both theoretically and empirically is if you look at the percentage of various mining pools and their evolution over time, basically the different color blocks are the share among all Bitcoin mining, how the shares of mining pools evolve over time. You do see them fluctuate, but you don't quite see them becoming over-concentrated. And so what is the intuition for that? At least without considering other issues. The intuition is essentially, I'm sharing my risk. It's like a portfolio management. I don't contribute 100% of my computation to the largest mining pool. I probably want to allocate a bit to the other mining pools as well because it diversifies my risk of not getting the block reward and all that. There's an additional I/O force, which is what do large firms do? They have market power. They can extract more rent. So larger pools also charge a higher fee to join the pool. And if anything, in terms of percentage growth, they grow smaller or slower than other pools. So if you only consider horizontal computation, there's no over-concentration. Yeah.
Could another story be that everyone is observing this, and if one mining pool gains too much power, then that sort of undermines the Bitcoin security story. So maybe they self-regulate to stay away from 51%.
Absolutely, and that was explicitly discussed in some forums. People are saying we're getting too big. Do we downsize and all that? We can't rule that out. But I think these are also plausible mechanisms why they don't grow too concentrated. I guess the main point, either through your mechanism or this particular mechanism, the kind of takeaway is, at least for horizontal concentration, we don't have to worry too much about. But there is an issue that we should worry about, and it was, till this day, still not emphasized much. That is, look at this red line. That's the aggregate mining power devoted to Bitcoin, or computation power, and it has been growing, right, over the years. Many people attribute that to the rise of Bitcoin price. And in fact, you can show it may not be first order. The first order is actually the rise of mining pools. And the intuition is very simple, right? If you allow bank robbers to write contracts to share their prison sentence, what do? Well, they're going to rob more banks. And here the miners are going to devote even more electricity if their risks are shared. And that can easily triple, quadruple the aggregate computation power based on some, ballpark calibration.
Wouldn't the exponential progress of ASICs be a much bigger contributing factor than arguably either one of those things?
Yeah, it could be. And that's another, I think there's several studies looking at that fixed cost element of mining. And from that, you can generate some of results to fit the pattern as well. But overall, the environmental issue has been a big issue, whether it's coming from the fixed cost of purchasing the mining equipment, or it's coming from the risk sharing. That has been a big issue, and we saw that big movement from proof of work to proof of stake, right? Lately with
IO explanation seems a bit kind of flawed because can you imagine them to be acting more forward-looking way?
Yeah,
right?
Absolutely. So I didn't show you the actual model and all that. It's a static model, two-pair model. If they are dynamically planning this, maybe they. If I really want to have a winner takes all.
First and then extract later.
That's right.
Yeah.
And there are these other forces, such as the self-regulation might kick in because they receive a lot of mining income, in any case. And some of the patterns would apply to staking pools as well, right? Because the basic market power argument and all that is not. It's only the energy or environmental implications that are unique to proof of work rather than proof of stake. And in terms of whether the systems are doing what they are most advocated for, right? We often talk about DeFi as being inclusive, it's democratic and all that. So let's take an initial look at Ethereum, which is the largest Web3 and DeFi ecosystem, to see, do we see bigger or higher inequality or lower than our real economy? Do we see inclusion? So what we observe is, I'm just going to summarize that for you, is, by the way, this requires a really large-scale computation. We run 14 clusters in one university to run some of the logic regressions using Ethereum data. Now, what we observe is in terms of income inequality, mining income inequality, there is a very high concentration. It's not too surprising that the top 3 to 5 mining pools receive most of the income, right? Over 70% of income. But even when you trace the distribution of mining income from the mining pool to the next layer of nodes, or next 2 layers of nodes, the top 5% of all the nodes are still contributing, about 60% of all the mining income. And that's quite a bit higher than the income inequality we observe in the US economy, for example, right? Top 10% is only getting 30% of the income, things like that. In terms of wealth distribution, actually I have the figures. Sorry about that. This is the tracing process. You can visualize that, and these are just percentile plots. In terms of on-chain wealth distribution, if we look at the ownership of ETH, it's also highly concentrated. This is a Herfindahl index over time. Initially, as more nodes join the system, it becomes less concentrated. But over time, it becomes even more concentrated. There's a general shift from peer-to-peer transactions in the network to DApp or DeFi protocol transactions. There's, in terms of percentage of actions, the ERC20 token activity has become more dominant over time than pure transactions in pure ethers. So those are some general trends, but concentration-wise, a lot of the wealth is concentrated in the top, 1 or 2 percentile. You can say those are exchanges. Maybe they hold many accounts. You can exclude known exchanges, and you still see heavy concentration. That concentration is comparable with Bitcoin, but higher than the wealth inequality in the real economy. So we can't quite say, this is, at least for the cyber economy, we can't quite say it's more equal in that way. What about, yes?
I don't think this is probably true, but it could be that, it's a bunch of people who had no wealth in the regular economy accumulate wealth in this economy.
Yeah.
And it could even, I doubt this is true. I'm saying in principle, it could even out the wealth distribution overall, even if this is highly concentrated.
Yeah, absolutely. The caveat is we don't see off-chain holdings, right? So this is only about on-chain distribution. And I think in Antoinette and Igor's work on Bitcoin, they try to trace some off-chain identity as well. And people with different risk tolerance and all that, they could allocate differently as well. So we can't say too much. Just in the data, that's what we observe.
Those are the ownership, not the mining pools.
Not the mining pools. It's the ownership of ETH and the income from mining within Ethereum.
The mining,
Yes.
I don't understand the mining comparison.
Yeah.
Because mining is a revenue-generating industrial activity. So to compare that with individual income from people doing work or investment, wouldn't a better analysis be comparing mining to other heavy capital cost industrial activity?
So I guess with the regular labor market, we concentrate our time and all that. And at least in these networks, I guess the computation power is kind of your resource that you're trying to allocate when we speak of mining. So in a way, there's some analogy to income, right? I input my time in the real world. Here, I input my electricity, and I get the reward. The key difference is I can be working for Cornell and Columbia at the same time, whereas in terms of mining, you can rotate over different mining pools. So it's getting a little bit closer to, the gig economy where people can rotate through different jobs.
I get that, but I'm like, no one's sitting there debating whether they should mine Bitcoin or like earn a salary. They're just not at all, like you have entrepreneurs who say, I have money and potentially technical expertise.
Yeah.
So it's like, I can set up a Bitcoin mining operation, or like I can go drill for oil. And I feel like those would be a lot more apples to apples comparisons than like, well, I can go get a job being an accountant, or I can mine Bitcoin. Like that's not the trade-off.
Yeah, fair enough. I think for a large set of nodes, maybe it's closer to industrial organization. That's larger in terms of operation scale. But there are also the ones who are just drowning mining pool, right? I just have my computer, and I don't spend a lot, but I can still contribute my computation to the mining pool. In that sense, either way, maybe we shouldn't call it labor, but it's a distribution of income to the nodes. That's what the income distribution is describing. So the comparison to the income inequality may not be appropriate. I guess what you're suggesting, we can look at the, let's say, firm revenue distribution. Yeah. That's something we can.
I mean, I understand like the original, you read the Satoshi white paper.
Yeah.
So it's like, oh, everybody's gonna mine using their CPU.
Right.
That was the original idealistic vision that every user is also a miner and stuff.
Yeah. Yeah.
We've moved on from that.
Reality is
Long time ago. Yeah.
That's right. Yeah, that's a great point. And what about distribution of transaction activities? It turns out that most of the transaction activities are concentrated on large transactions. And actually, for a very intuitive reason. Whether I'm sending $5 to pay for my coffee, or I'm sending $5 million to my Swiss account, invest in the next, Avalanche or something. The computation step is about the same. So the gas fee, the transaction fee, has a big fixed element, fixed component. And that's not favoring smaller players or small transactions. So in that sense, it's not very inclusive. For those guys who are making large, Swift transactions, maybe they can use this. But for someone, freelance worker trying to send back home some money, it may not be the right tool to use. So another issue with the transaction is, on average, 9.3 overall % of all transactions fail in Ethereum ecosystem. Bitcoin transactions never fail. It just gets delayed to be included in the block. But for Ethereum transaction, you have to reserve some gas, some transaction fee. And if you don't calculate or anticipate well, maybe you don't have enough gas. Out of gas is making 30% of all failed transactions. In case you are wondering why it adds to more than 100%, they are not mutually exclusive.
So what happens if fails?
It feels just that the transaction doesn't take place. Yeah, no transaction or a smart contract is not going to be executed.
So you have to redo it then?
You have to resubmit a similar.
But it does cost you money, a failed transaction.
Yeah, because they have
You run out of gas, you
Yeah,
pay for the
exactly.
you're right to the chain that
Yeah.
those transactions.
So in that sense, for it to be inclusive, we need it to be functional first. I think 9% of failure rate doesn't sound very functional. And that really highlights the importance of fee mechanism design many of you are working on. That's still wide open and could play a big role.
So do you pay gas fee in Ethereum?
Yeah.
Even if it fails?
Yes. Yeah.
It's a little bit like when you mail something
You
to
pay
the
this.
post office.
Yeah.
If you don't pay enough postage, it gets returned.
Yeah.
But you don't get the stamp back.
Yeah.
I see.
I mean, I would push back. I
It's
think
like
this is
old
not
helps.
an issue with the fee mechanism.
Yeah.
This is an issue with like the user's misunderstanding, right? Because the fee mechanism is how many ETH per unit of gas, right? But this is just like, you thought, it would take some amount of gas, it took more, and has nothing to do with the fee mechanism, right?
Well, there could be this behavioral element. For example, less of crypto savvy users, they just don't reserve the right amount, or maybe the fluctuation is too big, right? In terms of
Fluctuation in the price.
yes,
But so again, that would affect whether the miners look at your transaction at all. But once they look at it, it's kind of like you said, I was going to drive, I planned for enough gas to drive 10 miles,
Yeah.
and it was actually 20 miles, right? The fee mechanism has to do with the price of gas, but if you
Right.
only bought 10 miles worth of gas it doesn't matter what you paid, like
Yeah.
it's going to fail, right?
Yeah. And I agree with you. I think there's some linkage in the sense that, to the extent that fluctuation is big, that could affect my budget decision, right? How much I allocate and all that. And there's opportunity cost to the reserved amount as well. So I think those are all going to affect behavior. The reason I think fee mechanism could play a role in terms of maybe not so much of the direct failure, but in terms of financial inclusion is the following evidence. Basically, when EIP 1559, that was a change to the fee protocol that was introduced together as part of the London fork happened. There are several changes to the fee design. And one prominent element is some of the fees, the base fee, depending on the congestion of the system, will be burned, right? Sent to invalid addresses forever. And when we burn tokens, what are we doing? We're reducing aggregate supply. So it's a deflationary action. Who are paying those fees? We just said large transactions are paying those fees. So it's very similar to taxation, right? You take tokens from a subgroup, and all groups benefit when the aggregate supply decrease. Airdropping is a reverse process, right? You mint new tokens. It's inflationary action. You allocate to a subgroup. That's also a reshuffling of wealth. It's a wealth transfer. But if you do a diff analysis and all that with the introduction of fee burning, what you observe is the income inequality closes a little bit, and the activity inequality closes even more. So in a sense, some of these redistributive monetary policies seem to have an effect on leveling the playing field. I don't think they were specifically designed to make it more inclusive, because they were designed to deal with congestion and all that. But
Is this as measured by how many transactions fail or are reverted?
It's measured by the transaction frequency as well as transaction amount that actually went through.
But the
Not the failure part.
Not the failure.
Yeah.
So you have not looked at
We
whether.
have a look at the failure part, and that might be interesting, because just going back to CMAC's question on whether fee mechanism has something to do with the failure of transactions.
Because the other thing, see on that, like there are a lot of transactions that don't work out because it's a competition or a race and you lost. And I think those get counted as reverted transactions, right? Like
If they get a priority gas auction, yeah. But I think that's would be in the reverted bucket.
Right, yeah.
What I was arguing about was the out of gas.
Oh,
I
you were
think the
just
out of
talking
gas
about
is just
gas.
useless.
Yeah,
Yeah.
yeah.
It's not
But I
like,
think most of what you had was reverted, right?
Right, yeah, it's still a large percentage.
I don't think there's necessarily like a problem with reverted transactions. You know, you have an NFT mint, they say there's only gonna be 1,000. So people, one of the things they compete on is how much gas fees and time.
Yeah.
And a bunch of people try and lose. But to me, that's not in any way a negative thing. It's just like, again, like the radio station had a sweepstakes, and it's like the first 10 callers get something. If I call and I get
It's good failure.
Yeah. I think particularly on Ethereum during a bull market, there's a lot of those kind of shenanigans.
Yeah.
I mean, I don't know if they're good in the
That's
philosophical sense, but I think
Yeah.
technologically everything worked as we wanted to.
Makes sense. I think in terms of the description, we can kind of tone down the language a little bit. We are being a little bit too critical of the system. But now comes to the less ambiguous part. Outright scams and cyber crimes. So essentially, now skip this part. Basically, you can collect data from darknet and self-reported hacks and all that. And the tools that, I think I converted it to PDF. Sorry about that. The tools you can use is, even though you don't observe the identity of the wallets and all that, you can steal their past action. So you can link certain activities, right? If Alice and Bob always transfer the same amount to the same account, or take the same amount from the same account, maybe they are co-workers on an online shop and all that. So you can do a mapping of the any blockchain network. So if you have a victim, maybe by tracing their exchange wallet and see where the funds go, does it go through a mixture or some other intermediate steps before it is cashed out, can help you to trace or track down criminal activities. So if you do that exercise, in general, two types of criminal activities dominate the space. The second largest is ransomware attack, right? It's just planting a malicious software to lock up your data until you pay a ransom, and typically it's demanded in Bitcoin or some other cryptocurrencies. Actually, when I was moving to Cornell from Chicago a couple of years ago, I was driving, and on my way, I got this text message. We control your Gmail account, send us 2 Bitcoins. And indeed, my Gmail account was hacked, and I had to call T-Mobile and all that to get it fixed. Luckily, I think I got the control back without paying the Bitcoin. But it was kind of a ransomware attack.
What year was this?
2019.
2019, and they wanted 2 Bitcoins. Huh? Well, that is an ambitious
Yeah,
attack.
it's not a small amount, I guess.
Yeah, I think they might misunderstand how much college professors.
Yes, they didn't do the due diligence much, but the organized ransomware gangs, that's what we find to be really dominant in the space. They really operate as a business, as a company. They have people doing due diligence on the ability or willingness to pay of their victims. They use all types of ways to infiltrate your network and computer. They set up websites and chat apps for victims and the criminal gang to negotiate. And they offer ransomware as a service. They develop affiliates who takes a cut. Basically, someone who can use the USB to plant all this software. And they do several layers of extortion. One layer is just say, I'm not going to return your data. They can also threaten, I'm going to share your data with your customers or your rivals. All these can hurt the firm or the individual in question. And this is kind of a negotiation, supposed to be a real negotiation taken from the web. Basically, the criminals hold a lot of bargaining power. And they say, you just have to trust me. Send it to me, I'll give you the data because I care about my reputation. And indeed, they care about their reputation. They manage that over time. And they do research on, how much people can pay. And this is the total amount paid or received in Bitcoin over time. There's a huge run-up. What is the cause for that? There's a big.
How do you get these data on? How do you know what's ransom payments?
Yeah, so this is from self-reported attacks. So it could be underestimating many of the issues. But for the first few years, even with the delay, I think it's capturing some trend. And why is there an upward trend? Well, that has something to do with the pandemic. People are working from home, and home network security is not as secure. We also see a decline. The decline could be due to, just data not updated in a timely manner. But there's Also, another big driver, which is very intuitive, is there were a few cases of sanctions on ransomware attacks, and criminals are moving to more secure payment networks, right? Monero and some other networks rather than Bitcoin. So that could be explaining this. U.S. is the main target. Corporations, especially firms, underreport due to, number one, there isn't a standard place to report. Number two, there's no benefit of reporting, right? If you are a publicly listed firm, that could actually hurt your share price. The Treasury actually, the Office of Foreign Asset Control sanctioned one cyber criminal organization, Evil Corp. The name is very reflective of what they do.
I have a question.
Yes, yeah.
The previous slide.
Yeah.
Don't the firm they don't have an obligation to report these kind of things?
Well, I think in some countries there is guidance and rule that or regulation saying that you have to report this. But I think it's still a murky area overall, and that's a place where maybe clarity on the disclosure requirement and enforcement would be very useful.
Because for reputation,
Yeah.
most of firms would like to just say, yeah, we're very secure.
That's right, exactly.
That might be a way to enforce.
Yeah, and similar issue with data leakage and all that.
Exactly.
Yeah. So that's definitely so this part of the slides are not very exact. I think it's just describing some basic pattern. And with all these data caveat. And here what I'm trying to show is the revenue of Evil Corp. It was sanctioned in 2019. And they were getting more revenue. Why? Because they do a lot of rebranding. They develop a variant of the strain of the ransomware. They use a different server and all that. They do a lot of rebranding. And that's very common in the space. A bigger form of criminal activity is scam. That's by far the largest. And that has been with us for a long time in human history. So not too surprising. What is so new? Rug pulls are relatively new. Right? As coders developing DeFi protocols, leaving a backdoor, everything runs normal as people start to log all the tokens. And suddenly one day they just take out the token and exit.
Is that really new though? I feel like people have been investment advisors, have been money promising people they're going to do all sorts of things, and then they run with the money. So
I guess it's
technologically it's interesting.
That's right. Scam overall is not very new, but in terms of scale, it's pretty big. For example, Plus token involved over $2 billion being scammed. What's interesting is that it also involved more than 3 million victims. So it's not a big firm or big wealthy individual losing. It's a lot of ordinary folks losing money, and people are just using Telegram or even WeChat to get people. Oh, we have this great ICO opportunity. Invest with us. The CEO was trying to show up with the royal family. They organize academic even conferences. They do a lot of money laundering activities. So that's kind of what I have to say on the cyber crimes part. And now I'm going to switch gear to the tokenomics of staking, if that's okay. And this part is not so criminal. It's just about understanding, what this space is about. So again, I'll skip the earlier parts about the literature and the background. So what is staking in the space, in the DeFi space, right? Many of you heard of proof of stake. That's to provide consensus recording, right? That's one way of doing staking. You basically lock up some of your tokens to win the right to record what's going on. And then you get rewarded, token rewards. You could have higher level staking. For example, you can form an insurance pool or liquidity pool. People have to deposit their tokens into your DeFi protocol, and then you are giving them some rewards. Strictly speaking, these tokens are not fully locked, right? If it's providing liquidity, it's used somewhere and all that. But in many cases, they are not freely used as for transaction for other purposes if it's staked. And we get data on over 60 stakeable DeFi tokens. On average, you see 8% to 15% reward rate, which seemed to be high back then before all these programs start to collapse. But you can view it as a risky type of deposit, right, with banks, almost. What's interesting is that they are typically not set a predetermined rate of reward, but the aggregate reward amount, the budget for a staking reward is fixed. So if more people stake, presumably the staking reward rate is lower. That's what banks used to do. Nowadays, banks adjust rate, they don't adjust quantity anymore. But information-wise, the staking programs are typically pre-announced and all that. We got data from stakingrewards.com. And I'm really trying to draw an analogy with, maybe not the safe deposit, but CDs or some other risky instruments or investment products that's being offered. And the reward rate can be compared with interest rate. And if we view these cryptocurrencies or tokens as a form of currency, we can link it to how currencies and interest rate, right, interest rate parity that we observe in international finance. So that's the exercise we're going to do. So we first build a model, and the model basically has, it's in continuous time. There's one platform which has a productivity process that evolves over time. The random part is the diffusion term. The drift term could be a function of theta. Theta is what we call staking ratio. Basically, if more tokens are staked, let's say it's for securing the network is more secure. Therefore, the productivity goes up, right? There could be feedback. If you are not interested in that, you can just shut this down and take a constant drift. That's fine. Agents, there's a unit measure of agents. They're all price takers. They have potentially different wealth level at point T. And they are basically making an allocation decision. Do I allocate some wealth on-chain? Lowercase all indicate a numeric term, let's say US dollar or some fiat accounting unit. I can allocate some to on-chain for transactions, XT, right? Because I have to buy and sell storage space on Filecoin. I can allocate some to staking program. I lock it up, get reward. I can save some for off-chain, maybe for my consumption. And the token convenience, we just take the functional form from our earlier work. That is, if you allocate more to transaction, you can carry out more transactions. You derive more convenience. If the productivity of the platform is higher, you get more as well. And you pay some constant cost of maintaining the nodes or running the nodes. Yes?
So you had a lot of different types of staking on the prior slide, right?
Yes.
So just to sort of pick two, which I sort of know about.
Yeah.
One is like, let's say, proof of stake staking.
That's right.
Where the main thing seems to be you trade off earning some interest versus maybe some smart contract risk, but also really like locking up your tokens, right? But then the other is like, let's say, staking in a like Uniswap, where really like you earn fees, but you pay adverse selection, right? Which is very different, right? So this is more oriented towards the first.
That's right. That's right. It's a kind of full information system, asymmetric information kind of set up there.
But also people aren't trading against you. Like it's very, like, I mean, yes, people use the word staking in all those settings, but those are very different economic environments, right?
Yeah, that's right. People are not trading against me, and we introduce a cost of maintaining that staking position. It's smoothed over time, but it can be viewed as a cost of potentially losing your stake tokens or getting slashed if you don't perform.
Or whatever the cost is, maybe also add some idealized model of adverse selection or something. Okay.
But the limitation of the model is we treat it as we treat all these stakeable tokens to have the same set of same cost, running cost function.
Okay.
I guess one way to address your concern is to introduce some heterogeneity, but we have to think how to set that number.
What's the interpretation of V? DV?
So V is the convenience flow that the individual gets, right? If I put XT amount of real resources on chain, it's going to allow me to carry out certain transactions activities, and that gives me convenience. It's essentially a way of modeling money, right, or utility flow of these tokens. Money in utility type of reduced form. Now, the macroeconomists, monetary economists don't like this. They want it to be micro-funded, right? Exchange in the morning you sell, evening you buy, but for tractability. But very important, and that shows up in the international finance literature, is there's transaction costs in off-chain consumption. And that's why saving some wealth off-chain reduces the consumption transaction cost. It's just like having some cash makes it easier for me to buy food and all that. And so the transaction cost is decreasing in N, but increasing in the amount you actually consume, right? That's very standard in international finance. What that allows you to do is to create some differential in the convenience that putting wealth on-chain versus putting off-chain, wealth off-chain, right, in terms of consumption and deriving convenience utility. The reward process is very reduced form. It could come from two elements. One element is Q is the total amount of tokens outstanding, and A is the productivity I already said. So there could be a element that's related to the total number of tokens out there, and many staking programs, try to cap their inflation rate and all that, right, as a form of subsidizing the staking rewards. F could be coming from the fees. That's a random element. Depending on the business fluctuation, it could go up and down. And for simplicity, we're just going to treat them as proportional to the total number of tokens out there. It's not a weak assumption. You can try some other forms, but we have to put down a form to solve this model. And the reward rate is then the total number of tokens saved as reward divided by total number of tokens staked. As I said, you can introduce a slashing rate like a running cost. And the token price will be endogenous. A staking ratio is essentially aggregating all the staked tokens divided by total number of tokens out there, right? So what we find is staking ratio, aggregate staking ratio is a very important variable. So the model can be solved. Yes?
Is there an opportunity cost for staking in the model?
It's endogenously modeled. The opportunity cost is the consumption convenience off-chain, and the transaction convenience of saving that on-chain, but not in the staked program. And many of you work on mean-field game theory. That's how we can solve this, right? The wealth distribution will evolve over time based on all the optimal decisions, individual optimal decisions. And I'll just skip this part. You can solve this numerically, and to derive this mean-field game equilibrium, and essentially solving a fixed point problem. Individuals take staking reward rate as given to determine how much they stake and all that. Aggregating all the stakes will pin down the reward rate in equilibrium, right? So you have to solve that problem. And the key model implication, I'll just mention two of them. One of them is higher staking ratio is going to predict higher price appreciation. And uncover interest rate parity is violated. And I'll explain a bit more here. So basically, if you have a higher staking ratio, your mu, right, the drift term, is going to be higher. The blue line allows the staking ratio to feed back to the productivity process, right? So there's a reinforcement effect. But even if you shut down that feedback, right, by looking at this gray dotted line, what you see is higher staking ratio leads to higher price appreciation. I'll offer you a static intuition. That's not the exact mechanism, but it gives you some idea. So if more tokens are staked, they are locked for that instant from circulation. You have less tokens out there to clear all business transactions. Now, if the velocity of money doesn't change very quickly, token price has to appreciate to clear all these business transactions. So you can view it as a trade-off between the usage convenience and other convenience. And another way to think about this is when less tokens are staked, that means their transaction utility must be relatively high. That's why people use them rather than stake them. That means the platform's productivity must be high, AT must be high. And when AT is high, that means a lot of the wealth are already allocated on-chain, real wealth. So the room for further appreciation of tokens is limited. That's why lower staking ratio also corresponds to lower expected price appreciation. And do this bear out in the data? Well, you can actually look at that. So this is the mean staking ratio plotted, mean staking reward ratio plotted as mean staking ratio. Basically, this is very intuitive. If you offer a high reward rate, more people stake, right? So that's not surprising. But if you, this is just verifying that. This is the main regression. If you control for other characteristics, you look at aggregate staking ratio, use it to predict 1 day to 1 month return or price appreciation. High staking ratio do lead to high appreciation. And this is tied to the idea of uncovered interest rate parity, right? Basically, in international finance, what we observe is a country's currency, when the currency is appreciating relative to another country, the interest rate is also higher. That's why it's called a violation. Here, we have a similar phenomenon. The ones with higher staking ratio, well, remember those are the ones with higher reward rate, right? Because otherwise you wouldn't attract as much staking. But higher staking ratio are also corresponding to higher price appreciation. So you see that uncovered interest rate parity being violated. And what you can do with that is you can sort tokens based on aggregate staking ratio or the concept of carry. And if you construct a portfolio to do that, you actually, whether you do long short, if you think shorting is too hard to do, you can do a long only portfolio. And before last year, it was doing very well, of course. And the long short one, even after last year's collapse in the market, the long short strategy is still doing fine. It's just cumulative return over time. So there's a very profitable carry trade strategy in the space.
Across different staking tokens?
Across different.
What
We took the average of different pairs of.
And what tokens are included in this set?
So all the 60 stakeable tokens from stakingrewards.com, and they cover the major ones.
So one of the things to be aware of when you're doing coin by coin comparisons for staking is that depending on how old the coin is and how it was originally logged, like a lot of the newer projects, you have very high percentage staking because basically like 3 entities control 50% of the coins. Yeah. And a lot of them are VCs that are locked up. So this is hotly debated in the industry that it's not you can't compare like an Ethereum that was launched 8 years ago with.
Yeah, that's a great point. We try to control for the age of the platform. It's not a perfect proxy, but yeah. I think I ran over time, so I'll stop here. Let me just show one slide. This one, actually. I think overall there's still a lot of unanswered questions, and whether it's dark side or the market is doing well, that doesn't quite affect the research side too much. There's many new phenomena. Unless the market is gone, and this becomes too niche topic, but we'll see how that evolves. Thank you for all the comments and questions.